Good evening, everybody. Thanks for coming out. Really appreciate the opportunity to be here with you. So I'm a tax partner with Sitchin Cooperman. Been with the firm a little over 12 years, and with more than 22 plus years, doing this type of work. And I'm a partnership and pass-through entity specialist um, with a kind of heavy expertise in the real estate space. Doing a lot of times we're working with my clients and their professional teams, attorneys, QIs, helping them, advising on their tax technical matters, whether it's partnership related or transactional related. So just basically doing a lot in terms of the 1031 space. So there's a lot of activity that we see generally during the year, and yeah, happy to be here with you guys, especially with this team here. So guys want to introduce yourselves?
Sure. So my name is Eric Brescher, and I'm an attorney and a certified exchange specialist. There are only approximately 175 in the country. I serve as a qualified intermediary for 1031 exchanges. It's a role that a taxpayer's attorney, accountant, realtor is not permitted to perform. I think we're going to talk a little bit later about the QI space and the nature of being unregulated. But I work for a subsidiary of a $56 billion bank. So we provide a significantly higher level of security to the taxpayers' transactions. So the company's been around for over 30 years, as has the bank. So it's a little bit about us, and I know we're going to get into a variety of the underpinnings of them.
Yep. And he's one of the best. I'm David Becker. I'm the head equity strategist at Time Equities. I'm also a senior director on the investment committee. So I play a couple different roles. So Time Equities is a international real estate investment development company. We have, about 45, 50 million square feet throughout the U.S., Canada. I think we're in 35 states in the U.S., Canada, and 6 Western European countries and the Caribbean. So I have the honor of being involved in a lot of different projects with a lot of different people in different markets, different places. And the nature of the firm has been very diversified from inception. So we're a little bit unusual in that we are very diversified. I'd say we primarily focus on the major real estate food groups: industrial, residential, office, retail, student housing. And then, of course, we build buildings. We occasionally will buy or own like a parking garage or a specialty asset. So we see a lot of different things, particularly here in the U.S. And we're typically a buy and hold company, and we use 1031 exchange capital a lot for a lot of our new acquisitions, which we do.
Okay, great. So just to kind of set the stage here a little bit, I just wanted to share with you guys that our goal for tonight, we're going to probably start out just because so much of the rest of our conversation is going to be touching upon so many of the technical issues surrounding 1031s. We're going to just take a few minutes at the very beginning to cover just what some of the 1031 criteria is and the purpose and kind of how it works. And then we're going to enter in kind of a discussion section. And then we're leaving time at the end in case people have questions. We'd love to, help with covering, all of your questions if you have any. So that'd be great. So to get started, if we think about 1031s, right, what's the purpose of it? Obviously, I'm sure there's probably a lot of people in the room who already know. There's tax provision, which is effectively, in play so that a person can defer paying taxes on gains on the sale of real estate. So if someone were to sell a property for $10 million, right, what are they generally going to have, right? If they either sold it as an individual or through, let's say, an interest in a partnership, where the gains are going to flow through, let's say, to the individual owners, let's say, what are they going to look at? Capital gains at long-term capital gains rates at 20%. If there's gains that are associated with depreciation recapture, looking at 25% tax rate. Net investment income tax, 3.8%. And then depending on where the property is located, there's going to potentially be state tax ramifications as well. So when you're looking at, cumulative 30 plus percentage of taxes, right, you could see the incentive of why this is such a strong planning strategy, right? To be able to, especially when you're going to reinvest that money into real estate, you want to do it with pre-tax dollars. So what are the three main requirements, right? This main criteria that must be met in order for the transactions to be respected as an exchange. So you have to have an exchange of like kind property, which is real estate for real estate. And you have to meet what's called the held for requirement, which the properties must be held for use, for productive use in a trade or business or for investment. So if you take just a second to take a look at each one of those. An exchange, a sale of a piece of property followed by a purchase of a piece of property does not constitute an exchange from the IRS's perspective. So it is absolutely critical that if you're doing a transaction, that you're engaging a qualified intermediary like Eric, and to help with facilitating the transaction. Basically, what happens, you're selling a piece of property, proceeds go to the qualified intermediary, and there's very, very important timing requirements where the clock starts ticking. You have a 45-day requirement to identify property that you want to replace with the property that you gave up. And there's a 180-day period where you have to close on your replacement property within that period in order to satisfy the rules. And then generally what happens once you receive, the proceeds from the sale of the first property are then used to acquire the property that you are replacing. So when all of that happens and you follow those rules, the IRS is going to say that's an exchange. The most important thing is that the taxpayer never touched the money, right? So they didn't have access to it either constructively or actually, because again, if they just have a sale followed by a purchase, they're going to say you had the money, you're going to have gains recognized, you're going to have to pay taxes. So when we take a look at the second requirement, right, exchange, like kind property. So prior to 2018, the like kind exchange rules were applicable to tangible property as well. So when you were looking at situations where if you wanted to exchange, let's say a bus for a bus or a plane for a plane, it was much more important to make sure that you were meeting that like kind requirement. For real estate, it's much more broad. So basically, it's not a factor of the asset class or whether it's developed or otherwise. Real estate for real estate is pretty broad. So you can have someone coming out of a commercial property looking to go into, let's say, an apartment complex, or have just basically anything like that, or even for undeveloped land. So that's really, really important, right? Because there's flexibility there. Two other really important aspects of what else would constitute real estate for this purpose is an interest in what's called a DST, a Delaware Statutory Trust. And so basically it's effectively an interest in like a grantor trust that's disregarded. And so the IRS at the end of the day is saying that your interest in that is effectively interest in real estate, so we'll allow it. The second most important aspect here, because it's going to come up a lot in our conversation, is having ownership in real estate in the form of what's called a tenancy in common ownership, or TIC. So this is a fractional piece of an interest in real estate. So this becomes a really, really important aspect to some of the structuring that we see that happens around 1031s, and we'll cover that as well. The third prong, right? Exchange for like-kind property that's held for use in a traded business or for investment. So actually, before I go there, we talk about what doesn't constitute real estate. So what we see and what I generally see a lot of the times in the partnership space is interests in a partnership do not constitute real estate for this purpose. And so if someone wanted to, sell their interest in a partnership and try and use 1031, it's not going to work for that purpose. Other than that, personal use property is not allowed, as well as property that is held for sale. So if you have inventory property, or property that's deemed to be inventory by someone who's holding their property out for sale, and they want to basically try to avoid what's called dealer status, because even if it's to the extent of one transaction, if that property is held for sale and it's deemed to be like a type of inventory, it won't be allowed. So the third prong, talking about the held for, right? So we just spoke about it. If you're holding property and it's a principal residence, right? You're using for personal purposes, it's not going to be eligible for 1031. Same as what we just discussed here with the dealer property, right? So holding, the held for requirement applies to both the relinquished property, which is the property you're giving up, which is, the taxpayer has to establish that this is always their intent, right? That it's meeting this requirement of being in a trader business, whether it's like a warehouse or something that's part of the essence of the business. And it also applies to the replacement property that they're taking back, right? So if someone wanted to give up, let's say, a commercial property and replace it with, let's say, a vacation home, that's not going to work because they've got to meet that held for requirement on the tail end of the transaction as well.
Well, Anthony, just to chime in also.
Sure.
So just with regard to a primary residence, yes, there's a Section 121 exclusion for somebody's primary residence that they've lived into the last 5 years. But if you have a two-family, for example, you can bifurcate that sale. So if they live in half, they're going to get that 121 exclusion on the primary piece. But if there's an investment component, because it's a two-family, or maybe they have an accessory dwelling unit over the garage, that component can be exchanged, just to be clear.
That's an excellent point. And a lot of times, like if you take a look at the tax return of the owner of that company or of that property, right? They're generally going to be reporting that aspect of it as the rental on, a separate schedule. It's going to show their rental activity. They'll probably be taking depreciation for the property. And this is the kind of evidence, right, that's really strong to support the fact that it's held for investment and therefore would be qualifying.
And sometimes you would go as far as to set that up because in certain places of the country, the value of housing has gone up so drastically, even for your permanent, that it makes sense for you to rent it out for
100%. I had somebody in San Francisco many years ago. They paid $1 million for their primary residence. They sold it for $15 million. They moved out of it. They treated it as an investment property for it was 3 or 4 years, and they didn't exchange. And by the way, there isn't a safe harbor for second homes and vacation homes. We don't have to get into that, but there are some limited exceptions where you can use it personally. I mean, the spirit of a 1031, as you said, the Bulker case gives us that the intent must be to hold it for investment, not to liquidate it, not to use it personally. So you're not just buying a property and then moving into it. Again, there's very limited personal use via the safe harbor for second homes and vacation homes. But that's, again, why developers, flippers can't do it, because their intent is to buy it, a little spackle and paint, and sell it 30 days later, or they're holding it as inventory.
Excellent. No, that's exactly on point. So another takeaway here is only 2 more points here, and then we'll get into some of the discussion. When we take a look at the actual calculation, right? If someone were to sell their property, there's a realized gain, right? And so in order to determine how much of that realized gain is recognized, there's a reference to what's called the net equity computation. So one's net equity in the real estate that they hold is effectively the fair value of the property that they're giving up, less any debt that is related to that property or otherwise, that's collateralized by that property. And that's your net equity. So if an exchange could result in 100% deferral of that realized gain, right? None of it could be recognized, or some of it. It could be what's called a partial, deferral. And so when you're looking at your net equity, right? If you want 100% deferral, there's 3, components that have to be met. You have to replace and utilize all the proceeds from the sale of the first property that enter into the 10 with the qualified intermediary that has to be used for acquiring the replacement property. You have to invest whatever the fair value of the property was that you gave up. You want to what's called trade up, right? So it's either you're investing in another property that's either equal in value or greater, and then you have to replace the debt. If there was any debt on the property that you're giving up, it's advisable to have either equal or great amount of debt. So with all of those aspects being met, you're going to be able to defer 100% of your gain. But if there's any nuances to that where any of those, factors are not working out to where your net equity is being reduced, or you're not necessarily replacing all of that, and you have, let's say, relief of liabilities, then you can have what's called boot. So boot is like the bad word that everyone tries to avoid in a 1031, because boot effectively means recognized gain. And that boot can be if you're giving up property A in exchange for property B plus cash, right? Then you're actually getting money back. So it can actually be in the form of real money back. It could be in the form of receipt of non-like-kind property. So if you receive something else that's not effectively real estate, or you have relief of liabilities. So the relief of liabilities is deemed to be cash received. So those are really important components there. And then the final rule I just want to kind of go over is the same taxpayer rule. So effectively what this means is the taxpayer that's engaging in the 1031 exchange and having property that they want to give up and exchange, that has to be the same taxpayer that's taking back the property. So if we're talking about, let's say, a very common structure that we have is a partnership that owns an interest in a single member LLC, that single member LLC is disregarded for tax purposes, and the taxpayer that's doing that exchange is the partnership that owns the single member LLC 100%. So it is possible where if that partnership creates a new LLC to acquire the new property, that's okay because ultimately it's just passed through and you're looking through to the ultimate parent company of the owner of that LLC. So it's just another aspect to consider because some of the stuff that we plan to cover here tonight is going to touch upon these rules here. So again, appreciate the time for that. So now,
That was a very good breakdown. A lot of technicality.
you know, it's
I mean, that's the 100,000-foot view,
Yeah.
not even the 30,000-foot view.
yeah, I was going to say there's definitely nuances to all of those little pieces that we just discussed here. And at the end of the day, anyone who's interested in doing any type of transaction like this is so important to be thinking ahead in advance. And we'll see examples.
And this is why you need, obviously, really, really quality professionals helping you. You know, I come at it from an entirely different place, which is that I'm the investor or developer and represent other investor or development partners. So what I like to think about when I think about 1031s is where it came from and why. And why did the government come up with a rule for this to exist in the real estate space? And it goes back to, I think, 1921.
Correct.
1921. And basically, back then, they were trying to encourage the industrialists and the wealthy landlords to reinvest in the economy because of all the follow-on effects it has. So if you really think about what happened, it was basically a way to go to all of the wealthy people and say, well, if you sell your property, don't just put it under your mattress or keep it in the bank, reinvest it, which will then spawn all these other service providing things, accountants, qualifieds, attorneys, contractors to renovate property, all of the various things. And that was a very healthy thing at the time. And frankly, if you really think about it, it goes way back. So when I think about 1031, I think about, well, who's got the money, right? I mean, and how do you keep the money if you have the money? Or if you don't have any money, how do you make the money? And if you go back in world history, who really has the money, right? Basically, it's the people that own, and it's not the people that sold. So just if you just come away with that concept, you can understand how certain families over years have become fabulously wealthy because they've essentially transacted where they've sold the value of their property, not paid the tax, and rolled it into something new and held that property. And so it's this constant ladder. And of course, time, if you're going back, certainly in the US, time has certainly been on your side. And so when you get this generational dynamic happening, when it transfers from one generation to another, it becomes very, very, very substantial. And so there are many people, particularly, let's say, here in New York or maybe on the West Coast, where values have gone from one generation to another generation so stratospherically that for them to sell, they likely are giving away half the money to the government. Some instances more when you factor in other costs and transaction things and of that nature. So it's become a very, very useful tool for existing real estate people, but it also has become very useful for investors who actually haven't even seen much gain, but have taken the benefits on an annual basis of getting cash flow that's been sheltered from taxable income. So, you know, in the simple example, if you sell a $20 million property, you buy a $20 million property, 5 years later, you sell a $20 million property. And I'm just using an example, like, you know, there is, and you sell it for the same price, there's likely a very substantial portion that would be taxable, even if you sold it at the same price, because you took those annual deductions each year. So
By annual deductions, you mean depreciation.
Depreciation,
So,
yeah. So, which lowers your tax basis and then creates a gain if you sell it. So it applies to far more people than you'd actually think. than just sort of that very wealthy group of investors. It applies to most investors that have held property for some substantial period of time. So I look at it from that context, and it's also, if you really think about it, it's just another form of capital to go acquire property. So there's a couple different ways you can buy a property. The bank can loan you the money, and then you put the cash equity in. You can go get it from a 1031 exchange, which means that investor becomes the equity portion or part of that equity. So those are like important features for someone like me who's out raising capital to help us acquire properties wherever we think there's an interesting opportunity. And it's very misunderstood to a lot of the real estate professionals because they sort of like, I guess the way it's been marketed, the way that it's perceived many times by people who really don't take the time to think about it is that, well, it's a 1031, it's a 6% Walgreens deal or something. It's like one small, tiny fraction of what it services. It's actually capital and it comes in a form that is, from our point of view, advantageous because there's time frames. So you sort of know where you are with your investor base. And so you can move from property to property type, like Anthony had said. So it's become a very large part of the real estate investment business. Yeah, it's highly misunderstood in my mind.
Yeah, I think that hits right upon kind of where my next question, which is effectively there's a lot of non-tax reasons why a business is going to have some type of a disposition, right? And whether it's risk and they're looking for diversity, right? Because an exchange doesn't necessarily have to be one property for one property. It could be one for three or one for four, especially if you're looking to take in investor money and put new equity in. Because let's say you sell a property for $10 million with no debt, and you want to reinvest it into something that's $20 million. Well, you're going to have your 10 million from the first sale, then you could raise money and put in new equity to buy something bigger, right? So I think that's that investment opportunity there.
Yeah, I mean, there are a few strategies around 1031s. Obviously, the tax motivation is the reason that people are doing 1031s, but diversity, whether it's geographically or by asset class or by number of properties, that's what taxpayers often are trying to accomplish. Maybe, again, I mentioned the person that had a single family. That's like an oddball situation, appreciated so greatly. They want to diversify into other types of asset classes and, again, geographic wise. It can be used by estate planning. So, if you have a parent that has two children and maybe one's on the West Coast, one's on the East Coast, and they have different investment, strategies, all different types of reasons people will go into different investments. And, David has a specific investment strategy, much like the Delaware Statutory Trust sponsors, where they have institutional grade property that somebody that's selling $1 million property isn't getting into an Amazon facility or $100 million apartment complex. So it's an opportunity to have a fractional co-ownership interest. In David's case, it's through a TIC structure. Again, Anthony mentioned the Delaware Statutory Trust earlier. That's just another structure that, have been blessed by the IRS. So, everybody has different, objectives. Maybe they're just looking for purely passive income. But ultimately, it just taxpayer by taxpayer. And we should mention both with yours and with Delaware Statutory Trusts, these can only be sold to accredited investors. So there are net worth requirements or income thresholds that they have to meet to get into it. So it's a very sort of unique strategy that, and, we kind of talk about wealth you were mentioning earlier. Like, I like to get away from that a little because 1031s, half of 1031s are under $1 million. That's just the data point.
Yeah.
Plain and simple.
It's a huge volume orientation.
It's just a big misconception that this is something only used by the wealthy. It is not the case.
And in fact, I think regular investors, everyday investors should be thinking about this because it's a way for them to retain their gain and grow it as opposed to a reboot and start over. And, that's very hard. And most people can't do that in a way that larger, wealthier families might.
I mean, I always say it's like a 1-2 punch. They're taking a hit on their net worth And that tax that they're paying, had it been invested, I assume maybe a 5% fair return. Let's assume they got a 5% return. That's lost income in perpetuity that they just left on the table if they don't do a 1031 exchange.
So if I may, just to shift a little bit to the actual process itself, right? Because, the QI is such an essential component.
Yeah.
So tell us a little bit about, what should a person be looking for in a QI? And when do you normally get involved in that process?
Yeah, so I can be involved as early as an investor is just contemplating selling an investment, or a partnership contemplating selling an investment. I mean, that would be sort of a point in which, we start having a little dialogue. When you kind of go down the slippery slope, the time when I have to be involved is when they're in contract to sell their asset. That's when I have to be involved because, as you mentioned earlier, we have to structure an exchange as opposed to having a sale followed by a purchase. Technically, there's exchange agreements, but ultimately there is an assignment agreement. There is an agreement where that taxpayer is assigning their contract of sale to me, to our company. And then similarly, upon their acquisition, they are going to assign their purchase contract to the qualified intermediary. And so, you mentioned a little bit about the history of 1031s. From 1921 up through the 70s when we had the Starker case, David and I swapped deeds or we swapped cattle, and it was a simultaneous two-party transaction. But in the 80s, through the tax changes, and then 90s when we had new regulations, it allowed for this deferral mechanism. So when you hear about 1031s, somebody is selling their asset to one party and buying from a completely third party. But that wasn't the way it was, for 50 some odd years. So what happens is I have to be involved again before that closing occurs. There's an assignment of that contract, some other additional things that have to take place. And then, as Anthony mentioned earlier, that net equity, which, contemplates paying off a principal balance, maybe their brokerage fee, transfer taxes, whatever that net number is going to come into the exchange account if they're looking to defer everything. As you mentioned, it's not an all or nothing proposition. I have taxpayers all the time say, we just want to take 100,000, we want to take 50,000. You can do that. Doesn't blow your exchange. You're going to lock yourself into some taxes on it. Maybe they have carry forward losses, but it doesn't have to be all or nothing. And at that point, when the closing occurs, the money's going to get typically wired into the account that we establish at our bank. We will generate those critical deadlines. You mentioned the 45, the 180, and they will have to identify to us their potential replacement property. And that's a whole separate conversation. But you should understand that the 1031 exchange industry, qualified intermediary industry, is unregulated. And we have seen Ponzi schemes. We've seen bankruptcies. One of the largest title insurance companies went bankrupt because of their 1031 division and investments that they made that they shouldn't have. There's a whole episode on American Greed about QI defalcation. So again, I'm part of a bank. Of course, we're subject to government oversight. So, those are the types of things that you would want to look for. Ideally, we also set up every exchange through a trust. So again, you can do hopefully some due diligence on a qualified intermediary, but it's an integral part of an exchange.
Yeah,
you have to have it.
And the QI, many times, if you get someone experienced like Eric, who's reputable, he can help guide you through the process in a way that makes you think about, whether you designate one way or another way, like the 3-property rule or the 200% rule. We will also get involved in that early stage, or many times earlier. We'll refer one of our investment groups who we know is selling to someone like Eric or another qualified, and then work with them through that process to set it up so that when we have a property that we're ready to acquire under the guidelines that work for 1031, we can work with Eric, his firm, whoever, and other professionals to sort of time it so that it can be used as purchase equity for the new acquisition.
So I'd love to chat a little bit about what I generally tend to see as one of the most common questions, right, or situations, right, in a partnership setting where you have a partnership that owns a piece of real estate, and you have a number of partners that are invested in the partnership. Part of them want to do a 1031, part of them want to cash out. So, we see as one of the most common strategies is what's referred to as the drop and swap. So I know you had mentioned that with the drop and swap, right, a part of that, you're effectively the partnership is they don't necessarily need to liquidate, but they would be making a distribution of the real estate out to the investors so that each investor can have their interest held in a tick. And that tick is basically that fractional piece so that when they go to sell the property, in effect, you have each partner that's coming to the table with their own piece of property that when they have the sale, they'll be able to determine for themselves if they want to do their own like kind exchange, deal with the qualified intermediary, right? Engaging a qualified intermediary to help them out with that, or to just take the proceeds and pay the tax and go on their merry way. So this is a very common strategy, but it comes with certain issues because remember the held for requirement requires that you're holding property for productive use in a traded business or for investment. So if let's say you had a partnership that liquidates out that piece of property, and now, a month later, right, everyone comes to the closing table looking to sell. Well, can an argument be made that that person's intent was to hold that property simply for sale, which would make it not valid for a 1031 exchange? So it's really, really important that for that type of transaction or event, that there's advanced planning to navigate the timing rules, right? There's no black and white rule that says you got to hold it for a certain amount of time. But if you're generally, it's like a 2-year period or maybe a period that covers 2 tax years, right? Because in effect, if I'm holding an interest in a piece of real estate and I'm reporting it on my tax return, right? I'm showing the income, showing the depreciation, like we spoke about before. That's kind of a good evidence, right, for meeting that held for requirement.
We don't see much of it though, really. It's very hard to do unless you own a property with few partners and no debt, because the bank doesn't like you taking an entity and splitting it up into pieces and having them all of a sudden chase down. I'm not. It obviously can be done. The way
No, but
Anthony
you're
is
right.
indicating,
Yeah.
but it's a difficult process. It happens with, I would say, more experienced investors or a few investors, maybe family, and like Anthony said, it's a very planned out thing. There are other ways to get diversification or to accomplish the objective of what I think Anthony is alluding to, which is when partners don't really either have the same objective, they're not in the same financial position. One needs liquidity, one doesn't want to pay the tax. And so what triggers the tax is the sale, of course. But financing, on the other hand, doesn't. And so we use financing in a very active way to create a liquidity event. And sometimes that liquidity event can be used by one partner to buy out another partner, meaning they buy the shares of whatever corporation is or LLC entity, in which case it just shifts to them and then they have the control then to go and sell. Whereas the other person, okay, they didn't care about doing an exchange, so they're going to pay the tax on their exit. But in some instances, just financing alone can create, meaning you do a 1031, you have this imputed equity, then you put financing on it, distribute back what would be whatever their desire is, and then they still own it long term, sort of into perpetuity or for whatever period of time. But they were able to achieve some diversification, liquidity, et cetera.
Yeah, I mean, there are other strategies people utilize, partnership divisions. I mean, any of these things are going to require cooperation. And so, like to your point, like you could do refinance on the back end, you could do a swap and then a drop. Ultimately, you got to have cooperation. And, if the three of us are selling this building and I want my money because maybe I got a stepped up tax base because my family owned it, now I just inherited, I have no interest in waiting another day, right? So it's always going to be facts and circumstances driven as to what the best strategy is. And, there was a very favorable case in New York just this past June for a drop and swap, a perfect, beautiful set of facts that allowed it to occur. Not the norm. 75% of the time, somebody comes to me, they're in contract as a partnership, and then they say, oh, and by the way, we want to go our separate ways. So that's not a good look, but people do the drop and swap anyway. So yeah, I mean, you always have to take what you're given, though.
Yeah.
Let's talk about the market a little bit. I think it's interesting to put this in context of how it relates to the real estate market.
Sure,
I want to stay here in the United States because that's really what 1031 is.
Yeah. So
which we didn't mention, which is this is a federal tax dynamic, not international. Those are there's a whole nother set of
Well, but you can do foreign exchanges.
Right.
And what we didn't mention early on when you talked about like kind was that all U.S. property can be exchanged for all U.S. property. All foreign property can be exchanged for other foreign property. You just never can exchange into or outside the U.S. border.
Yeah, and oddly, we have a large portfolio in the Netherlands, in and around Amsterdam, and they have a different version of the 1031. They get a lot more time, but they have different restrictions and whatnot. But it's just interesting that every country might come at it from a different point of view, depending on where it started and what they're trying to encourage in their group of investor base, for capital.
So, Dave, you mentioned that you have a couple of deals that are active right now, right? That you're pursuing 1031 treatment.
Yeah, I guess. Yeah, I guess before I hit on the few different ways that we do it, or a couple deals, there's a lot going on in the marketplace right now. I get the question actively, well, is it a good time to buy or sell? And I'm sort of like, well, on what day, where, what market? They're all different. People think like the market moves in this very macro way, and oddly, it doesn't. There are a few things that move in tandem together, like how maybe interest rates might affect real estate is the obvious one. But geographic location, value increases, employment, all those things have a huge impact on what you're seeing in different parts of the country right now. So, there are certain places right now where, me personally, I'm very bullish because they're welcoming in the business. So, whereas a lot of the value from 1031, not like that hard to figure out, comes from the coast and maybe like parts of Florida. I think I've seen large transition of wealth. Not saying it can't happen in the Midwest. It does happen with farmers, oddly. When farmers are selling acreage, it's actually a good exchange. But there are certain areas that are welcoming in the capital much more business friendly. So, we have a covered land deal in downtown Nashville, where we're essentially buying a net lease, buying it all cash, likely all with 1031 exchange capital. And it's got a lease, so it clips a coupon. We're waiting. And the purpose would really be to satisfy an exchange in a very friendly way. And then in, say, 5-7 years down the road, look to build some high rises, some residential high rises, and see a land lift there and give people an option to either exit then or continue on and stay in the new deal. It's important because I think what you find is there's nothing. Well, when you lose a property in real estate, it's very, very painful. But you know what's more painful? Losing a property when you have a 1031 exchange, because it reverts back to your original basis. And so in many instances, this becomes a very, very important decision for investors to know where they're going. And just like, Eric explained how there's some bad actors in the exchange, qualified world, whether it's a bad actor or a bad deal, you have to really be thinking ahead. And when you're doing these exchanges, because if it slips, you're going back to day one. And
that comes back to due diligence. We're just seeing that right now in the Delaware statutory trust space, where there's a sponsor that, I don't know if they're going to go bust or what, but they suspended their distribution. So that's where, when you're dealing with somebody like David and Time Equities, they have a long history. You're buying that sponsor, right? So that's where you have to look, because there are DSTs that go bust. There were ticks, back in the day in the financial meltdown that went bust, and people pivoted. But because I suspect, because of the nature of you're doing construction, that's something that cannot be done within the Delaware statutory trust format, which is why you use a different structure.
Right.
But you never want the tax motivation alone to be pushing your acquisition. You want to make a solid investment. I talk to people about that all the time. They shouldn't just be buying something just for the sake.
Yeah, no, the tax advantage should be accretive to why you're buying something in the first place, and to be able to use it and match it with the right capital. But it shouldn't be the driver. Just by way of example, as part of our business, we do a lot of different things. We buy properties, we build properties. We also have like a loan program where we offer B notes, and so those aren't real estate acquisitions, but we're playing sort of like a mezz position for a coupon, that's higher. But we do that with the understanding that if we have to own it, we will at the basis of our last dollar. So we were involved in a project in Vancouver, Washington, nice area, beautiful market, just north of Portland. Brand new 170 unit apartment complex. And the developer got caught in the window that we saw ourselves in the last 5 years. So he built a great product, got it leased up, interest rates took off on him. And in this instance, he had some other issues, and we were sitting in a B-no position. And although it wasn't our business plan, because it's not why we entered the deal, we ended up having to foreclose him out, take over the first, and repositioned it. And now, oddly, we're offering it as an all-cash exchange by just reinventing the whole project, because the underlying real estate is solid and it's a large apartment complex in a good market and it's brand new. But unfortunately, this was one of those situations where, certain things happen in the market, timing, whatever it was, and couldn't get it leased up fast enough, and lost it. And we ended up taking over, and we're offering out as a core plus deal, just because of how we entered it.
Are you guys seeing any transactions that are like development projects where it might be where what's being replaced is the land and there's the opportunity to build? And how is that impacted with regards to everything that's happening in the market, whether it's rising costs or interest rates and on borrowing, things like that?
Well, what I'm seeing a tremendous increase are reverse exchanges. What we've been talking about are the forward exchanges where taxpayer sells their existing investment first, and then within those critical deadlines we mentioned, buys a replacement. But there are two other strategies that are often used, and reverse exchanges are one of them, where taxpayer can actually be opportunistic, acquire an investment first. We flip the deadlines. Now they have 180 days to sell one of their existing investments. Maybe they only have one, so we all understand what they're going to sell. They may have other assets in different tax-paying entities. And again, they'd have to identify and enter into certain agreements with us to make it work. But it is regularly done. It was blessed back in 2000, and we follow the revenue procedure to the T. So understand it's a more complex transaction. I'm just kind of boiling it down to the idea that you can actually buy something first. Obviously, you need to have the capital.
You need to have
do
the
it.
money.
You got to have the
Right.
money to do
So
it.
that's typically why people don't get involved. But interestingly enough, it's, double to triple in some months over past reverse exchange activity. But that same structure is also used, to your question, Anthony, about doing improvement exchanges. And so you can actually trade down in value, sell a $5 million asset, buy a $4 million asset, and use that delta to make improvements within the deadlines. And then that allows you to have ultimately spent the $5 million, assuming you can do it within the period of time. So that's a common strategy that people utilize.
Yeah, I to be honest with you, my job would be a lot easier if everyone did reverses. The hardest thing from where I sit, and I think Eric can certainly appreciate this, is the timing. It's the idea that it's just that simple to match up these dates. Sometimes we negotiate on deals for months and months at a time, sometimes years, on both the sale and the buy side. And so you're sitting here timing and if you think about this individual investor, they don't have the portfolio we have at Time Equity. So, whereas we can be creative, we can do a reverse, buy something, take timing sort of out of the equation. We try and offer that to our investors when we can, because it's a huge accommodation to be able to take that process, which means that if they haven't closed on their sale yet, but they like the deal that we've offered them, bridge it for them essentially and hold their position and then let them close in when they're ready. But I would say that the timing and it's less about, well, not less, they're both important, the 180 days of closing from end to end, but the 45 days where you're really locked in, and 45 days comes in a minute.
But it's like I say to people, they're not going to wait till their closing of their sale to first start looking for replacement property. They're in contract to sell. It's going to be 60 or 90 days. Start having the dialogue. And I would think you love the critical deadlines, because it's pushing people. Ultimately, they're going to use you as a backup, or maybe that's their primary strategy. So, we didn't get into the ID rules, but, they have the ability to have a backup and maybe to list, a piece of your property, or maybe that's their primary objective. And so,
No,
that,
the only
that
thing
works
about,
well for its sponsors.
the only thing about that is we take it so personal that it's like we have to, we're out there trying to close a property. It's not like we just are sitting on all this equity that's available for sale. And then we get that call, that panicked call with someone who's got 10 days left. I had one today, large investor. What do you have? I have 10 days. So it's sort of like, well, it's not only what do I have, it's where can I put you? Like that it's not already accounted for. It's not wanting to go buy something just to sake of buy something. It's having that sort of that integrity of actually buying something because what we really do is we try and evaluate the deal, whether we're going to buy it critically first, and then we think about once we made the decision, done the initial due diligence, then think about okay, what's the right capital? Who is it for? Who's out there? Whose timing works? So it's tricky. And it does cause certain investors to make rash decisions. And so we try and alleviate that when we can.
And that's actually, I mean, obviously, if you can help to accommodate them, right? That's certainly, but there's a lot that goes into it,
Yep.
right? So is that generally where you see like the usage of the DSTs? Is that people kind of use that as a fallback when they know, oh my, I've only got this amount of time left and I haven't identified the right properties or whatever?
So that's a good. So again, it's not all or nothing. Somebody could sell a $5 million property, lock in on a $4 million that they're going to buy directly themselves, and they have $1 million left over, and they say, what am I going to do with that? So that's sometimes, as you mentioned, the term boot, like that's sometimes where the DSTs or a tick could come into play. But yeah, I mean, sometimes that's again, sometimes their primary strategy. It oftentimes depends around their debt and equity requirements. We didn't get into discussing, but, unfortunately you mentioned earlier that client that you ended up buying their property. But, as we talked about earlier, the requirement is to spend all the equity and to replace all the debt. It doesn't necessarily mean that every exchange has equity. Sometimes people are upside down on their property, but they will still have a tax issue because of debt forgiveness or of cancellation of indemnus income. So it's a situation, and I had somebody with a $30 million property. They were upside down. They had just a nominal amount of equity, but they used the DST strategy. There are some that are out there that are very highly leveraged. It's designed to replace 85% of the debt. And then conversely, it can be used. Sometimes people want liquidity, so they put $1 million of equity into this DST strategy. And then, as early as 30 days, it's a little questionable how much you should really wait. That interest in the DST is refinanced, and they get 85% of their equity out. So there are a variety of strategies in the DST space and in the tick for that matter that people utilize. So
we appeal a little bit of a different audience because we our preferable way to offer product. We have $1 million minimum policy in our exchange program because of how we do ticks, and if there's a bank involved, there's a limit there typically, and
also just by virtue of a tick structure, revenue procedure 2002-22 limits you to 35 investors. So you don't have the ability, unlike a DST, could have hundreds of investors.
Right, and oddly, in the Vancouver property I was alluding to, I keep an eye on where our average number is and how many slots I have left, because now for us, so I can't, on the front end of that capital raise, I can't be taking $300,000-$400,000 amounts from people because it would chew up all my slots, and I'd be left with 10 slots to fill 30 million. So at the tail end, if I have the space, and that's what we tell people that that becomes a critical piece of this, that you're maxed out. And because we do a lot of deals all cash, you can raise a large amount of money in that way. Our preferable way to present our deals is really to go to the client in a really custom strategy. And, just like Eric, where he wants to know in advance when a client's coming inbound, get his ducks in order. Well, we want to start looking at people that we know are selling, in a perfect world, 90 days before they sell, 60 days, 30 days. I'd even take when they're in contract, because it's much easier to design a custom product for them, meaning you understand what their objectives are. You look for that sort of anchor deal that you're going to have. You look for the diversification. And in some instances, we would just, by assignment, go on and say, look, we can go out and with enough time, use our resources to essentially go out and custom design something for some of the large investors, and we do it somewhat, more regularly than you think, and it adds to a lot of capital. And oddly, even though we have a fund business, um, and we have access to all the sort of primary large banks, this has become a very, very substantial, meaningful part of our capital flow right now.
And David's different with the tick structure, and you're more hands-on with the clients because you are the company. But it should be noted that the Delaware statutory trust space, those are not sold by brokers, and those sponsors don't deal with the taxpayer really directly. They're sold by financial advisors, people that have a securities license. So that's a whole nother universe, a little different, right? Because you're not going through.
Well, we're going through
Right.
financial advisors.
You will do that as well.
We do.
Okay.
Well, we're a broker dealer also. We don't have to take it through our broker dealer, but we actually oddly became a broker dealer. We've been a broker dealer since 2000, but we became actually a more active user of our broker dealer, really from a compliance control point of view. So we're a big enough firm where we didn't really want to rely on a third party. The law about syndication when you're a real estate investor is a little bit gray. It's if you do it on a regular course of business, then it really should be a security. And so we obviously raise capital in a regular way to retail investors.
But it is sold by a private placement now.
Yeah, all private placement.
Yeah, DSTs. Yeah.
But I guess what I was saying is like we sort of go to the financial advisors, we get direct investors, and occasionally we'll have an institution or a large family office, and they all have some different criteria. So you try and put people in the same deal that have sort of matched objectives.